Wouldn't it be nice to know which way you are going to trade before you even start your trading day? I say that because, let's be honest, most retail traders execute on trades only to realize afterwards, when they're already in the wrong trade, that they shouldn't have jumped in so quickly and actually should have taken the time to figure out their game plan well before they started their trading day. This one basic change that you are going to learn about today can make a significant difference to your equity curve to the tune of many thousands of dollars. I've seen it time and time again with new junior institutional traders that came into the firms I was working in, and it can work just as easily for you, even if you're a retail trader working from home. So together, in the next few minutes, let's do some work. It sounds tough, but you're going to absolutely enjoy it, because we are going to take your trading game up a level so you can also have a very good idea of what you want to do well before you start your trading day. So as I mentioned there in the opening to this video, we're really going to take your trading to the next level, and you can see that here in front of you. We're going to give you some real actionable things, and that's where professional traders really differ from retail traders. It's very simple what you're going to see us work on together, and it's very doable for you. It is going to result in the things that I said at the open, in terms of having an increased equity curve. This is my equity curve. We're going to go through it after we've looked at the change that I think you should make, and hopefully you'll have the same result. We'll have a look at some real trades that were taken, and we will go through things like the footprint you can see here. So very, very exciting. So you'll actually see, as you can see here, actual live trades that I've taken, and we'll cover them in looking at things like real volume, order flow. However, before we do that, let's actually put together on paper, and then you can implement it too, this one big change that anyone can do to actually raise their equity curve, as you've seen there. Now, this change, it does require you to have more of a professional mindset, and that will lend itself towards straight away the game plan you have becoming more professional in itself, because your mindset is changing. And really, I'm going to get down to it, okay? So no need to mess about. I'll actually tell you exactly what we're going to be looking at, is thinking about creating a context for the day, okay? We see a lot of retail traders and new institutional traders focus a lot on execution. You know, they open up the charts and quickly find a trade and then they execute. It's a completely separate part of your trading day, execution. The context for the day needs to be completely simple. Still keep it simple, this context element, but the key is it's done before, okay? It's done before you start trading, okay? As you can see me highlighting up here. This is going to allow you to set yourself apart from pretty much the entire community, okay? Because most people don't do this. Think about when you go to work, the best people at work, right? You either get just people who are just there for the sake of it, or you get people who really excel at work. Those people come in, they already kind of know what their day is going to look like, what their week is going to look like. And to do that, you obviously need to kind of change it up a little bit. I did mention it's only one change. We're going to have a look at that now. What we're actually going to do is we're going to have a look at a context example together. It's amazing, and obviously you'll be able to follow along, and you'll see how simple it is for you to do. Just a couple of things to point out. It can be done at the weekend. In fact, I encourage you to do a lot of this at the weekend, because you see, as I said in the opening to the video, before you even start trading, you've already given yourself a massive advantage. You're going to see that. That's one of the contributing factors to me having that type of equity curve. It allows you to be clear before you trade. Okay, so you're not getting into the trading day confused about what you want to do. You already know, and I'll show you why it's really important that you already know beforehand what you're going to do. So let's actually have a look at an example together. Now, what I've done is I've put together the sort of things I was looking at myself this week. So there are different ways of looking at context, okay? It can be kind of, so don't worry, it doesn't have to be exactly what I'm looking at here. In terms of this one big change you're making, it can be macro context you apply, it can be different types of context. You know, you could be looking at specific types of volume analysis, which I'm going to show you as well, slightly broader based before you open any price charts. That's the key. You know, if you think about retail, they go straight onto price, right? Professional traders are not doing that. I promise you, it's only going to end in disaster. You probably know this already because you're not seeing the consistency that you want in terms of that profit, that equity curve, which is why you're in trading, right? You're in this to make money, and end of the day, having a positive equity curve is only going to make you money. So it's very important that you understand what I'm saying. Now, in terms of macro analysis, so if you decide you want to do your work at the weekend or before, you know, the key, I keep saying it a lot, before. If you want to do whatever type of work you want to do before your trading session, if you decide it's macro, I'm literally just going to have one page. This page, I said keep it simple, one page, okay? So don't worry, I'm not going to bog you down with lots of graphs and data. It's literally one page. It can take you 10, 15, 20 minutes, and we'll actually do it together. We won't even spend 10, 15 minutes. We'll spend 2 minutes, and we'll still come to the same conclusion. So depends on what market you're trading, although as I've said many times in previous videos, they all correlate together. I trade the equity market a lot. What's it been doing? Coming into this week, we've had a pullback, a big pullback of around 8%. Okay, now when I say context, we need to put some context around that. You know, is that 8% pullback a disaster? What's been happening before the 8% pullback? Do that, we just go slightly further back and we can actually see the same 8% pullback here. So can you see, actually straight away we can see actually maybe we don't need to panic so much. Maybe when everyone else is panicking and having this negative bias, maybe actually my bias should be positive, right? Now obviously macro is a lot more than that. Do we actually have the factors to back that up? It's fairly simple. If you think about persistent sort of bearish markets, what do you typically tend to need in terms of a macro context for those to continue? You typically need what? Recessionary environment. So forgive my handwriting. Obviously I trade a lot, I don't write a lot, but it is what it is. You probably also need, you know, profits at companies to be in decline. So you need a recession, profits at companies to be in decline, and maybe some sort of shock to the system, you know. So it could be that the Fed is hiking, or it could alternatively be some sort of price shock, you know, like housing prices collapsing. We haven't had any of that. Are we in a recessionary environment at the moment? Not at all. GDP is positive. Corporate profits, are they negative? No, they're very positive. Is the Fed hiking? No, it's likely, and that's why I've put this data here. Inflation is coming down quite aggressively. We just saw that recently as well. Just saw year-on-year print below 3%, and also we're now expecting 4 rate cuts. Okay, so the complete opposite of what you would expect in a bearish market. Therefore, all the things we're seeing right now suggest that potentially could have a great opportunity to get long. Okay, the point is not you need to get bogged down in any of this. My point is, do you see how long that took? 2-3 minutes for us to have a very good contextual feel for which way we want to trade. I haven't even opened any price charts. Now, an alternative way of looking at context is, you know, if you're not necessarily a big fundamental fan, that's absolutely fine. But again, you need to get away from necessarily looking at price, because it's not really going to tell you much in terms of the overall feeling of the market, the sentiment of the market before you start trading. You know, price is obviously useful, and we'll have a look at that together when we get to the execution stage. But when we're looking here in terms of, you know, what's the market trying to achieve? Where's it ultimately trying to go? We need to look at the market slightly differently. And this is where professionals really set themselves apart from retail traders, okay? They recognize that the market is really driven by what? Volume, right? It's volume that's driving the market. Think about it. What is volume? It's people buying and selling. If that volume, if people buying and selling is volume, that means if there was no one buying and selling, that would mean there was no volume. You still have price, but without volume, price wouldn't move. So it stands to reason, if you're not looking at volume, you're going to end up in big trouble. That's the point. So this is something called market profile. You can look at volume profile. It's very simple. It's just the days of the week. Okay, so you can even see it here. For example, you've got Wednesday, you've got Tuesday, you've got Monday, you've got Friday, and so on and so forth. Okay, so kind of what we can see already here is that volume for each day. You can see where kind of these little clunks of volume are here. You had two areas where there was a lot of trading here. This little area here is obviously quite important. There was a lot of people building what? Positions. We can see straight away that volume itself, or people's kind of sentiment, volume is sentiment, right? Because if you're buying, you have positive sentiment. It's moving up, right? So already we're quite bullish, and that backs up the macro context that we just looked at. And then you've got this volume here, and you can see on a previous day, the market has broken out. It's come back and done what? Tested the buyers from the previous day, and the market really supports what all the buyers are trying to do. They're trying to push the market up. So I know I've kind of gone through it quite quickly there, but I just wanted to show you, small changes. Looking at things like this, any retail trader can look at market profile, very easily accessible. It can really take you, from maybe having a flat equity curve to or losing it, really take you to that next level. Okay, so that is what context is. We're now going to actually have a look at a trade I took based on that context, right? So we're already bullish, very bullish, based on two different types of contextual ideas that I've taken before I've even opened a chart, right? How many of you are doing this before you're even looking at a price chart? Okay, well then you're not trading professionally. You're very much stuck in that retail world. Okay, and I'm going to say this only once as a side note. Obviously, we see a lot of retail traders when they're watching videos, they're focusing on things like podcasts, and I've got nothing against them, but it's not going to help you become a better trader. What's really going to help you become a better trader is grabbing the bull by the horns, recognizing what professional traders are doing, and I'm showing you some of the things they're doing, and doing them. That is what's going to help you. So let's do that together. Now, I promised you before we were going to look at the charts, the price chart, and we will. But again, I want to look at it from a volume perspective. This is something called the footprint, where you can actually see executions taking place. It's going to help us a lot. Let me just highlight the trades that I'm actually going to go through. So it's these two trades that I took here. So 12th and 13th of August. Okay, these two trades here. And those are the two we're going to look at. Now, in terms of a price chart, right, keep it quite basic. You can see here, it's the 12th and the 13th. Obviously, very bullish days, which we already suspected they would be. So the context was done here, before. Okay, that's the point, before. Do you see, before? Same context for both days. I'd already kind of had a feel for what I wanted to do. And I said to you at the start why it's so important to have context. And the reason is, if you have a bullish context, say, coming into the market, do you see the market is going to tempt you a lot with some of these moves, pullbacks or whatever they are. And by doing that, you're going to be all over the place. You're going to get long, you're going to try and get short, then you're going to change your mind and maybe go long, and it's going to end up in your equity curve doing that, or even being a disaster. Look how clean my thought process is here. I'm only getting long. Even when I lose on trades, it's fine. I take a loss and then I get back long. Why? Because I've done the work before. It keeps my mind clear. It doesn't distract me. So what, we had a bit of a sell-off here. To me, that's just more opportunity to do what? Go back into my original context. Okay, so like I said before, keep your context and your execution separate. Okay, see, this is execution. This is execution. Context was what we did before. We weren't even doing it on a price chart. It was before, and that led us to believe that the market may be bullish. Execution is just going to allow us to execute the context. Okay, so the market was in kind of a range, moving kind of sideways in this range, and therefore that appeared to be quite a... I won't cover this trade because it was fairly straightforward, obviously moving in a trend upwards, fairly straightforward. This one was a bit more interesting because we did have a range, but ranges themselves can be quite bullish. I wasn't buying at the top of the range. If you're in a range, You want to buy at the bottom, right? And that's what I was doing, buying at the bottom. Now, obviously, you don't want to just look at a price chart. You need some help when it comes to actually timing your execution. So what we're going to do is we're going to get a microscope and we're going to go inside the price here. Okay, we'll do that together. And as I said at the start, anyone can do this. So just remember what we're doing here. We're going inside this area here. Okay, so I'm just going to move this out of the way. Okay, so this is where I entered. Can you see that? Right there. That's where I entered. There's a reason why I did that. If I just scrunch this up slightly, okay, what you'll see is we were in the range, right? So when we're in a range, what I want to see is, you know, we're in this range. What I want to see is as we get down to the bottom, I want to see aggression from the other side, from sellers. Right? And I need a way to identify that. If you have a price chart, how are you going to identify that? It's impossible. You just can't do it. You know, how do you know on a price chart here that there's aggression here? How do you know it's not there? How do you know it's not there? How do you know the exact point? You know, you could have ended up going slightly early. To identify that, you obviously need to be able to obtain more information about the inner workings of price. And what else is there apart from the actual buying and selling that took place when price was moving? So that's what this is telling us. You can see that price was very aggressive and it was creating a lot of imbalances. Okay, well, that imbalance is very straightforward. So you can see imbalance is just a ratio in the favor of sellers. So, you know, these are sellers, these are buyers. Same as when you're on your execution panel and you have, you know, two prices here, could be 56, could be 57. You hit that to buy, you hit that to sell. Okay, so it's sellers and buyers. You can see here I've scrunched up a little bit so you can't see the full number, but for example here I can see 89 executions. Here I see 0. So do you see the ratio is 89 to 0 in favor of the sellers? That's why it's red. So very kind of sell side focused, right? So you can see a lot of selling with very little buying. And we kind of see that here in the delta percentage as well, which I won't go through a lot, but it is highlighted. It's basically just telling us the ratio of selling is very strong compared to the buying. This is very useful information for us, because if we've got a bunch of people here who are selling very aggressively, if the market goes against them, what are they going to do? They're going to get out of their positions. Okay, so that's again very useful information for us. Where, if you were a seller here, where would you get out of your position? You'd do it above, wouldn't you? You'd do it above you. So do you see, this is people talk about support and resistance, and I'm going to be honest with you, years working on some serious trading floors, that is not how traders are looking at support and resistance. What they're looking at is, where are people in trouble, right? And that makes sense. If you're a seller and you've sold here and the price goes above you, it's going to force you into action, right? And that's all that matters. That's what's going to cause the price to move up. So we're looking for price to leave this kind of 53, 55 area. Okay, so remember that area, 53, 55, and you can see that is where I started to enter my long trades, 53, 55, which is this area here, 53, 55. Okay, do you see? No coincidence. It allows us to also have very good risk management just below, because if the price goes below, we're going to be out. Okay, and then you can see the end result. Market was very aggressive. Not only fresh buying coming in, but sellers getting out of it. So just to summarize, you've seen us talk about, you know, the macro context or volume context, whatever you want to do, introduce that into your trading, split out your pre-market context. Okay, and that can either be macro, it can be volume based. Okay, move away from price only, and then when you come to execution, this is the bit I see retail doing. Okay, This is the bit I see professionals doing. So professionals are doing the whole spectrum. Retailers are just doing this bit. Can you see if you're just doing this bit, you're destined to fail, okay? Obviously you don't want to do that. Hopefully you found that useful. Check out this video if you want to find out more about how to trade professionally and if you're really serious about this business.